Investments are fraught with risk, and mutual funds are not uh, an exception. So in this video, I want to discuss the key risk associated with mutual fund investments, the risk, the pitfalls, or the drawbacks associated with mutual fund investments. I want to look at the risk involved one by one. Number one is market risk. Market risk. Mutual funds are subject to fluctuations in the financial markets. If the market declines, the value of the fund holdings may decrease, affecting the overall performance of the portfolio. An example is equity funds. Equity funds are particularly vulnerable to stock market volatility because it consists basically of different stocks. So when the market becomes volatile and when it fluctuates, in a case where there's a downturn in the market, the equity fund could be affected negatively. Number three is interest rate risk. Interest rate risk. Changes in interest rate can impact bond fund negatively. When rates rise, bond prices typically fall, leading to a potential loss for investors in bond mutual funds. Because there's an inverse relationship between equities and bonds. So whenever between interest rates and bonds, whenever interest rate rises, bond prices will fall. And whenever interest rate decreases, bond prices will rise. An example is a bond fund holding long-term bonds. This may experience greater losses during periods of rising interest rates. As I told us earlier, there's always an inverse relationship between prices of bonds and the prevailing interest rate. Number three is credit risk. Credit risk. This risk applies to bond funds and refers to the possibility that the bond issuers may default on interest payments or principal payments, reducing the value of the fund. In the case where the issuer can no longer cope with the interest, then the issuer could default, not only on interest alone, but may not be able to pay even the capital. So that risk is always there. An example is a high yield bond or junk bonds. These are more exposed to credit risk than investment grade government bond funds. Generally, if you are invested in a high yield bond fund, then you are more exposed to risk compared to investing in a fund that specializes in investment grade bonds. Number four is a liquidity risk. Liquidity risk. So in this context, discover that some mutual funds may invest in assets that are not easily sold. They cannot very easily dispose the assets, especially in time of market stress. This can delay redemption or forces the fund to sell assets at unfavorable prices. So liquidity here is the ability, of one being able, is the ability to buy or sell securities very easily. In the case where it's not easy to sell or buy, in that case, the asset concerned is considered somewhat illiquid. An example is a fund investing in real estate or small cap stocks. These funds may face challenges when it comes to liquidating their position. Generally, it's very difficult to sell real estate. It takes time compared to equities in the markets, compared to the stock markets. Number five is a manager risk. Manager risk. Actively managed funds depend on the skill of the managers. Poor investment decisions or mismanagement can lead to underperformance compared to the overall markets or index funds. So the manager could make poor decisions, and that would adversely affect the performance of the fund. An example is the fund manager's failure to adapt to market changes. This can result in significant losses. The manager ought to ought to act proactively, in expectation of market changes, so that when the changes eventually comes, it will not affect the portfolio so much. Number 6 is expense risk. Expense risk. High management fees and expenses can erode returns over time. Even if the fund performs well, excessive fees may reduce net gain for investors. So fee is actually an inherent part of a mutual fund investment, except maybe it's a no-load fund. In the case where it charges interest, it charges expense ratio, or charges fees or commission, then these will then definitely eat into the investors' returns. For instance, a fund with a 2% expense ratio will need to outperform low-cost alternative to provide comparable net returns. As the returns after fees should outperform an index fund, or else there's no point in investing in such a mutual fund. Please like this video and subscribe to this channel if you've not done that. Number 7 is inflation risk. Inflation can erode the real value of returns. Fixed income funds are particularly vulnerable as their payout may not keep pace with prevailing inflation. Let's say the interest on a typical bond, the coupon is maybe, let's say, maybe 9%, and inflation is 10%. You discover that the interest gain from your investment may not be able to keep pace with prevailing inflation rates. So a bond fund may yield maybe, let's say, 3% in an environment where the inflation is maybe 4%, as I earlier explained. Then that is a negative return. That's a cumulative negative returns. Number 8 is currency risk. Currency risk for those who invest internationally. So international mutual funds face risk. They face currency risk. And so where fluctuation in foreign currencies or exchange rates can impact the fund value. Generally, when there's fluctuation, which of course is quite common, then it will affect the value of the fund. So a weakening of the foreign currency relative to the investor's home country can reduce the fund's returns if the country you are invested in, if their currency is like weakened, or probably is a weakened currency. If they decide to float their currency or devalue their currency, it will affect you as an investor outside that particular country. So for instance, a weakening, if the currency, the country I invested in probably faces, as I told us earlier, faces a weakening currency, maybe through devaluation. If they start to float their currency, it will negatively impact your investment. Number 9 is concentration risk. Concentration risk. Funds that focus heavily on a particular sector or industry, or even regions, even a geographic region, may be more susceptible to adverse events in that area. If any events affect the sector, the industry, or the region, then it would equally impact your investments. For instance, a technology-focused funds may experience significant losses during a downturn in the tech sector, or maybe maybe the sector is probably undergoing, maybe there's a kind of what they call it, a new technology, that comes in to override existing ones. then it will certainly affect the sectors concerned. Number 10 is redemption risk. Redemption risk. So large-scale investor withdrawal can force mutual funds to sell assets quickly, potentially at unfavorable price. Favorable price is negatively affecting the remaining investors. If a large investor happen to kind of dispose their holdings, quickly, it may bring down the net asset value of the fund, and that will affect smaller investors in that fund. So, in conclusion, while mutual funds offer diversification and professional management, they are not without risk. The investors should assess their risk tolerance and carefully review their objective, their investment goals, and also look at the fees involved and diversify across different types of funds to mitigate potential losses in mutual fund investments.